I started off my trading with futures and then migrated over to stocks. I day traded for a while. And in 1999, I started doing the currency markets via the Forex. Before that, it was futures currencies. So most of my days now are, looking at the global economic picture with primarily a focus on currencies. I like to joke and say I trade money for money. And now I realize more so than ever, the last probably 16, 17 years, once you're a Forex trader, once you're a currency trader, the way you look at the connections between commodities and currencies, between equities and currencies, even between commodities and equities, you see the connective threads so much better. And that's why I love being a currency trader. I was so influenced by Charles Dow, who basically, codified Dow theory. That was posthumously, but he understood that price action linked back to a certain psychology. So we have these market trends or market phases. And I think the only way to really understand and trade the markets properly is not to say I'm a day trader and I'm going to force the market to work within this 5-minute time frame, or I'm an end of day trader and I'm a trend follower and I'll treat every market as a trend. Instead, I think you listen to the message of the market. The market will tell you I'm trending, I'm not trending. Focus on a short term, focus on a long term. So if we listen to the message of the market, I think, and really respect the structure, we're going to be far better off than imposing our will, imposing our style on the market, which I think at best yields a 50-50 result. And I think most traders have strategies, but they don't necessarily know what market environment they were designed for. They just continue to apply them over and over and over again without saying, oh, this is the trend fading, or a range fading strategy. Let me wait for a range to actually develop before I put this particular strategy to use. So it's kind of going back for having the right tool for the right job. It's not that any indicator is bad. I always say that it's like if you have a bag of screws and a hammer, it's just not going to do you any good. Not that the hammer's bad or not that the screws are bad, but together it just isn't a good combination.
I mostly use Elliot Wave for my trading. So I learned Elliot Wave back in 2010. So a friend of mine introduced it to me because I was reading about Elliot Waves and I didn't understand when people were talking about wave 3 or wave 4, So a friend told me like a course that I could take, and then I started taking them. And I found it really interesting, because Elliot Wave kind of give me a roadmap for me to trade, which give me like a bias for my trading. So having the roadmap is good for me. It's mostly leads me to pretty good trading. It took me a good 3 to 4 years to really master Elliot Waves. Yeah, not even mastering, kind of understand how to apply it and everything. I mean, drawing and putting up numbers, telling you this is wave 1, 2, 3, 4, that's easy, but how to use it really, really use it, it took me a good 3 to 4 years. I think I'm just waiting for the right setup, and I manage my risk. So, to be profitable in the market, you don't really have to trade every day or even a couple times a day. Even with good 2 to 3 trades a month, you can even make more money if you get a really good setup with a really good reward ratio. So the thing is try not to over trade, but just wait for the right setup to come to you. That way you'll make more money, and don't forget to manage your risk. I think the most important thing for traders is to fall in love with their charts. You need to treat your charts like your relationship. Trading is kind of like a relationship. When you fall in love with somebody, right? You give them your full trust and everything. It's the same thing as trading. You need to fall in love with your charts. You just have to trust whatever the chart is telling you instead of listening to somebody else or looking at the so-called expert or the guru. Just look at your own charts and then look what it's telling you. Everything is there. You just have to trust it. Just by looking at the chart, it kind of gives me a roadmap for my trading. So I know which direction I'm supposed to trade. But the thing is, even with a roadmap, the driver is the key. You still need to navigate all the turns and hazards. It's the same thing as in trading. Even though you know which direction your bias is, if you're long the market or short the market, you still need to find the best entry that you can get, and then you need to put a stop loss, and then so you know when you're wrong, and then also the target where we're heading. The charts could give you all that. You just have to look at it and then listen to your charts. I just move on to the next one. That's the best. I think that's the advice I would give somebody. The worst drawdown I have is like almost 10% of my account. I think it was like a few losses. I think it was like 8 in a row, something like that. So, but the thing is with trading, you can't just moan about it or anything. You just have to move on to the next trade. I mean, if you have a loss or something, then it means there's something wrong. You just have to look back to the chart and then see what mistake did you make, and then learn from it, and then just move on to the next one. Just learn from your own mistake. That's about it. In the beginning of my trading, I did blow up an account. I did blow up an account. So, and it was something that I learned. I learned to manage my risk. Instead of thinking about all the profits I could make. So that's why I only have small drawdowns now, because I really risk like as small as I can, so I wouldn't be too worried about the drawdowns at the end. In the beginning, I was expecting, I had that weird expectation too. I was hoping to like double my accounts in like a month or so.
Yeah.
And that's why I ended up blowing my account. But at the end, I kind of realized, when you're managing your risk, it's not possible to have that kind of amazing returns. So that's why I kind of set the expectation kind of lower for myself. So now when I trade, I'm risking only about 1% or less of my account. So my goal is about say 2 to 3% a month. So anything more than that, I consider it as a bonus for myself.
So what I used to do was basically I wanted to be able to watch the open. I wanted to be able to watch maybe 1 or 2 specific times during the day. One kind of earlier in the day, a little after Wall Street has their lunch and everyone's coming back. And then once about an hour and a half before the market close, and then right at the market close. So basically I wanted to, for maybe 5 minutes each, I wanted 3 or 4 times in the day where I could look at the market. And that's all I really needed to do as a swing trader. So if you can invest maybe 15 to 20 minutes during your workday, that's all you really need. So, I'd time my break around the market open. So for me, I was in Minnesota at the time, so that would be around 8:30, 8:30 in Minnesota. So I would basically time my breaks so I could be looking at my screen, from 8:30 to 8:40. Now it's much easier. You can just pull up your phone and quickly look at your stocks. Then I would 2 hours later I'd look at the market for another 5 minutes, and then another hour or 2 later again, and then near the close. And that's all you really needed to do. So have your watch list there specific with those 10 stocks, and just see what they're doing. And if you get the trigger, just quickly place a trade on your phone, and that's it. Prep is all done before that. So it's really not time consuming to do during the day. And no one's going to have to come in and say, hey, get off that and get back to work. You don't have to do any of that. It's really a simplified process. I classify the market basically from a macro perspective. I'll think of it like this. Is the market in a trend, or is it range bound? So if it's range bound, I'm going to be trading specific setups. For example, if we're in a range bound market and we're towards, say, the highs of the range, I'm going to be looking for a lot of failed breakouts, because the market is not trending at this point. So a lot of the stocks that are breaking the highs, whether it be recent highs or all-time highs, or whatever the time frame you're looking at, I'm going to have a bias towards trading a failed breakout setup. So if that setup triggers, I'm going to take it. Whereas in the market right now, where my expectation is we're running and we're going to see a trend, I'm not going to be looking for failed breakouts. I want to see the stocks that are running. So here, I'm going to be trading breakouts or continuation patterns.
Day trading to me is just focusing on a shorter term time frame, and I'll still trend follow on a 5 minute, right? Swing trading to me, the swings, and I define them a little bit differently, which is why I'm kind of diving into this. So swing trading to me, swings are synonymous with a retracement or a correction. So if I'm playing the swings, it's not a certain time frame or even a certain time horizon that I'm looking at. It's actually waiting for those corrections. So as a trend follower, I wait for pullbacks in an uptrend and bounces in a downtrend. So I don't mind trading a 5-minute if the organization is there. And if the, what I call contrast between a strength and weakness currency is there. In other words, if the pound is very strong on a given day and the yen is very weak on a one-day relative performance, that might be a very good candidate for me for a 5-minute or intraday day trade. Buy the pound, sell the yen, take advantage of the contrast. Now, on the other side, if I'm looking at a 30-day relative performance, I'll just look to trend follow in a longer term time frame, be it a daily or maybe a 4-hour. So it's really about the organization. I wait for the market to come to me. The market's got to walk up my, driveway, up my front porch, and knock on my door. If it doesn't do that, I'm not going to take the trade. I think a lot of people would be shocked at how little time I actually need to trade. My last book that I wrote was basically how do you spend an hour a day? And it wasn't really to be, catchy or the lazy person's way to trading. Even though Forex and most markets are, moving to a 24-hour open market, markets like futures are open, Globex hours are 24, Forex markets obviously are 24 hours. I think a lot of people think all 24 hours are created equal, and they're not. I think that your best trading hours are going to be typically between 8 a.m. and about 11:30 a.m. New York time, because you've got Frankfurt, Paris, London, and New York all trading at those hours. That's typically going to be your higher volatility time. And, if you look at the hours comparatively, 8 to 11:30 a.m. New York time and 8 to 11:30 p.m. New York time, you'll see that the volatility in the pip movement range is almost half of what it is earlier. So people don't realize that the market doesn't behave the same way throughout the day. And there's different opinion that's coming into the market at different times. And that's where I picked about 3 hours a day that are my main working hours. And anything aside from that really is where I can do other things with my life.